Hello, everybody. I'll be moderating this panel. My name is Ben Brandis, and I help lead Cross Country Consulting's private equity practice. Private equity is also an alternative strategy, so we'll mention that a little bit in this discussion. Cross Country is the leading financial consulting firm that improves the finance functions of companies, especially PE-backed sponsored companies, like all the companies that HIG invests in, as you mentioned, Marty. I don't know how you did it, but for some reason, you've got 4 Bostonians out of the 5 people participating in this. So though I know, Danye, you're not a Bostonian, I take it? We'd be 5 for 5. No. So I don't know if that was a coincidence, if you did it on purpose, but I assume that we're going to spend half this conversation on alternative strategies and half this conversation on all things good about Boston. So be prepared. I'm going to go through each of the panelists one by one, asking question introductions, and then we'll get into a group conversation. So Brian, let me start with you. You're using a proprietary method for your investing strategy. Can you just talk about that a bit? What makes that different and what makes that effective in this environment?
Good question, and the fact that we're from Boston matters. Defense does win championships. In fact, it even wins Super Bowls and World Series. We saw a great example on Monday night where we had conditions we've never seen before, and it had to be a changed game plan. Well, we're dealing with the same kind of thing in investments. And one of the things that we did back in our outsourced CIO days was to deal with the well-being of the institution. And that's what we're dealing with and what we're doing differently here. What is well-being? Is it the contentment, for family offices in particular, is it the contentment that you can rely very confidently on the high likelihood that when you need your money for whatever purpose, whether it's a benefactor or transition of generations or investments in private equity, VC, means, SPACs, what have you, that it would be there for you. And that's what we do. We are dealing, just like an airplane going through turbulence over time that is unexpected. We've adapted that capability and that science that we use for allocating across all kinds of asset classes to be able to take a very liquid menu of the most structurally stable ETFs and systematic cash and be able to target not returns, but for us, risk control is the outcome, returns will figure that out. And so we're looking to, as a core portfolio strategy, be able to not just manage risk, but to truncate the downside to provide for compounding returns, and ones that you can rely upon. We've been very lucky. Over 68 rolling one-year periods, 96% of them have been average positive 9%, only 3 negative. 1 minus 3.5, 1 minus 1.5, another at minus 3 basis points. So that's a high likelihood of expectation. The kind of thing that we'd like to be able to rely upon to be able to have it there to, in fact, potentially even eradicate the J curve for private equity investments, for reserve liquidity, where we look at that liquidity as a call option on opportunity, whatever that opportunity may be. That's our approach. That's what we have done, where we kind of changed the paradigm. Instead of having to go short or lever and have fractions and all kinds of complex instruments that impede on that liquidity, we'd rather deliver the liquidity, do the hedging through the math, and give the client control and transparency alongside that true liquidity in a market that is having constantly changing patterns of chaos. And all we're doing is looking at the path, pattern, and code movement of those return streams, to be able to minimize that downside, truncate, and deliver compounding positive returns. That's us.
Gotcha. You've mentioned defense initially. So I want to turn the intro and the question to Gary. when we had our conversation, Gary, you and all people have mentioned heightened risk in the market, hence possibly playing defense, as Gary mentioned.
Yeah,
Is
well,
this too much? Yeah, can you just opine on that and how you perceive behavioral risk as part of this?
Sure. So just by way of brief introduction, I kind of got introduced to investing when I was studying at MIT as an engineer and met Warren Buffett during the last financial bubble and in the late 90s. And that was my kind of introduction to value investing. Had the fortune of studying when I was at Fidelity under one of the best value investors that I know, Joel Tillinghast, who really taught me the value of predictable businesses and just rational economic analysis. And fast forward to today, I've been managing Silvering, which is a concentrated intrinsic value partnership, where the goal is safe compounding of capital, which I would argue is particularly relevant today because I'm pretty sure we are living through arguably the greatest financial bubble of our generation. And I don't think that this is an exaggeration. I think that I take a behavioral view on this, and I'm very much involved in thinking about behavioral finance and behavioral mental models as a way of both taking advantage of opportunities, but also guarding against risk. And so I think one of the most important things to do is to have a behavioral approach and understanding where the excesses are, understanding your own flaws and your own kind of blind spots, and trying to minimize them. Now, I manage a concentrated portfolio. It's about 10, 15 investments. I'm not really trying to manage volatility. I'm trying to make sure that when people give me money and they want it back in 10, 15, 20 years, they have a good return, but achieved safely, because I think in today's environment, reaching for that extra unit of risk is really, not worth it, because the returns might be there in the short term, but when the reckoning comes, it will be pretty painful.
Thank you. I can see that a theme of this is risk in the market, bubbles in the market, and we can dive deeper into that. Kevin, I think you've alleviated all this risk by exiting your investments somehow right before the pandemic. What are you thinking about getting back into the market now?
So just a little backstory. We manage money for the billionaire families, and I came out of Lehman Brothers. I actually went right through bankruptcy at Lehman. I just have to say it's a very expensive price for my freedom. So it was a tough time. At my last job at Lehman Brothers, I was a risk manager on the bond side for 17 years. My last appointment was like a to the real estate group, and that was I was a parajumper going into the fire, and there was no way we could sell the real estate risk fast enough. So it was a pretty turbulent, exciting, scary time for lots of people at Lehman and outside of Lehman. After the bankruptcy on Sunday, I started my company on Monday, not knowing I had a business plan. I didn't have a business plan before that. I just went on my own and said, I'm not going to get that kind of risk again. And we started to think about what to do and where we were at, given the structured, the role that structured finance played in that last bubble. And I was largely, not just personally responsible, but I was in that market of structured finance, whether it's CMBS or ABS or CDOs or CLOs, and all that leverage that went into the system. That was the business I was in. I quickly realized that in the real estate group, real estate people in the real estate of Wall Street don't understand structured finance. And structured finance people don't understand real estate. So that was kind of a really simple way to say, take those two different diagrams, put them together, and let's go look at the structured side. So that was the game plan. We did that. The problem was we didn't have any money. Right? Coming out of Lehman Brothers, where you go through a bankruptcy, you have no track record as a buy-side investor. Who's going to give you money? No credible institution will give you money. So we started doing family office investing before family office was vogue. And it was in vogue partly because the family was moving personally. I worked with them at Lehman. And so there was trust that was built. And I think the trust piece is a big piece of it. When we set up our investment vehicles, we set them up, we source the investment, we underwrite the investment, we diligence the investment, we put the business plan together, and then we capitalize it in an SPV we run it as a manager. And so we don't get paid until they get their money out plus a return. So we focus on transparency, we focus on alignment of interests, and we focus on making good investments. So when you're investing for a single family, you can't take diversified risk. You have to know that you're underwriting this, you better be right. And fortunately, we were right. We averaged about 35% of a dollar invested, weighted average over time. Now, granted, we were buying at the low point of post-crisis in 09-10, and then we started exiting a few years ago. And our last exit, Ben alluded to, was March 6th of last year. And it wasn't that we had any lens on what was going to happen in the world. We were distressed debt investors, so we bought everything in real estate, from loans to structured finance to control options, and using our real estate skills and our structured finance skills. The rhythm of the business was such that we started selling, and we got our last sale, and so we returned all capital to our investors on March 6th of last year, of 2020, thinking, a couple weeks later when the pandemic started to accelerate, and it was scary, it was unknown, I think, wow, that was a pretty good fortuitous sale. There's going to be distress. There has to be distress. You can't shut the world down. Now, 18 months later, I'm still scratching my head saying, I can't believe there's no distress. That real estate prices are tight. So there's, back to what to do next. We're very opportunistic. We're value-based. We're not momentum. We're not speculators. I too am very nervous when you just hear kind of anecdotal conversations, whether it's taxi or I was in the hospital with my son during he had an appendectomy, and 3 different conversations with nurses, orderlies, and technicians about how they're day trading crypto, day trading gold, they're day trading derivatives, and I'm sure they go, good God, and everything's on the phone, and then you overlay that speculation, the bubble that Gary referenced, to a valuation metric where you have Rivian comes out at $100 billion and they've produced, counted 156 trucks. Now, I just can't get my head around it. So we don't go near that. We're looking at opportunistic stuff. One of the things we're focusing on right now is we're trying to buy a very prominent U.S. company that went bankrupt. Everyone here knows this, everyone here has been in the stores. We're looking at buying a division of that out of the bankruptcy courts. We think it's interesting. We think there could be a tech enablement. So that's kind of what we're looking at.
So now I've heard bubbles, risks, not the proper return risk relationship in the marketplace. Danye, how are you talking to your investors about this? And does anyone want to put money to use in this environment?
Yeah, thanks, Ben. I come from a slightly different perspective because I work with Asian families who don't necessarily have a presence in the U.S. and specifically focus on helping them to allocate here. And by the way, on the note on Boston, I actually grew up in China and came from the northeast of China. Nobody knew my hometown, which is called Shenyang. But I always introduce myself as my hometown to Beijing is like Boston to New York. So there we go. There is a connection. Anyway, there we go. So I think, especially in the family office space, working as a fiduciary advisor and dealing with the geographic, cultural, and political gap, it's important to understand where people are coming from, what has happened in recent years, and where we need to go. So I summarize these just based on my experiences and a couple of things. Maybe not everybody deals with Asian investors, especially Asian families, but maybe this process or framework can help you when you're working with your client as well. So I have a lot of experiences. So before I started my own advisory, UniGlobe Capital, I worked at BlackRock for 9 years and actually joined in 2008, 2 months before Lehman went down. So that was the beginning of my career. But in terms of understanding how Asian families, where they come from, Asian market is a very competitive market because there's a lot of people. Whenever one investment idea gets hot, there's always tons of people going into it. So if you're dealing with ultra high net worth individuals or very wealthy families, trust is probably the most primary consideration. Because of the competitive dynamics, there's always so many people going after the same thing. How people institutionalize trust is a very different dynamic than Western society. As a result, a lot of the family offices in Asia they always crave for ownership when they look at investment opportunities because they don't trust anyone else unless they actually own a piece of, be it a real estate investment, be it a portion of the equity of the company. So historically, the asset classes that were most prevalent in Asia, especially China, are real estate and equity and almost nothing else. And it's also because the whole market dynamics is less sophisticated or not as much instrument in Asia aside from real estate and equity. There's venture capital and a variety of other asset classes or even hedge fund are relatively new phenomenon in the past like 5 to 10 years probably. And the other dimension is to understand what has happened along the way, especially in the most recent 5 or so years. One, there's actually new regulation coming out, especially in like large market of China, providing better definition of what is an alternative asset class. I think in the US perspective, our definition of alternative like is typically hedge fund, sometimes people put commodities in it as well, but real estate, venture capital, private equity, for example. But in China, because a lot of people are already investing in real estate, and they're probably more familiar with that asset classes, people's definition of alternative sometimes is very different. And prior to 2018, actually Chinese banks guarantee returns for retail investors, although the underlying investment could be venture capital and real estate. But that, with it coming out of the new regulation, that dynamic doesn't exist anymore. So people are forcing themselves to educate and getting more familiarized with what private equity, venture capital, hedge fund actually means and the risk they're actually taking and the return profile implications. And the other dimension is that, especially dealing with family offices, most of the wealth creation in Asia is still first generation. And we're just in the process of moving to the second generation, which is different from most of the Western society. A lot of the established families are like fifth, sixth, or even longer generation. But the good news is that a lot of the second generation from Asian family offices are well educated internationally. They might have working experiences in large investment banks or asset manager or hedge funds. So when they return to their home country, instead of taking over the family business, they typically get very involved in the family office investment activities, which is good for players like us in the market. And the last thing I just want to mention is about where to go. Ben, you asked a question, am I actually adding clients at this point? Actually, very actively so, because as you know, as people create wealth in the last, I guess, 1 or 2 decades, and Asian market has generated great returns for those family offices. Now, it's not just about wealth creation, it's about wealth preservation, as well as truly global asset allocation, as well as diversification. And the return profile in Asia going forward is not going to be the same as what it was generating the last decade or two. And US is still predominantly the primary destination of a lot of these capital inflows. And the US is a much wider and deeper market. And even just within the alternative asset class, it's not just about venture and private equity, it's also venture debt, private credit, direct lending, and within the hedge fund asset class, there's also a variety of different ways of investment in venture and market value that are not as prevalent in Asia, but potentially offer superior downside protection. So that is very attractive to the Asian family office community. And the last thing I want to mention is that I started off saying Asian families crave ownership. So historically, they would always want to do direct deals rather than allocating to funds. But that dynamic has also changed in recent years because they realized they had to pay to play. They can't just come in once a company comes to growth stage or pre-IPO and say, oh, I want that deal because I have money. So they realize they need to build relationships with maybe early stage venture fund and to get that access and to do the homework works through advisors like me to create that infrastructure to allocate to funds for deal flow and eventually for co-investment instead of always trusting their ownership to get access to great deals because as a sophisticated, mature market like the US, it just doesn't work that way. And I think a lot of the Asian family offices are eventually picking up on that, which makes my job both easier but also busy because then I need to be a very good fund selector.
Great, thank you. It seems like everybody here is active. Danye, there's people who still want to invest even in this market, given all the discussions and risks that we've talked about. I'm going to start opening some questions to the group, but this is kind of based on something, Brian, that you said, so maybe I'll start with you, is you mentioned your proprietary model that has worked in a number of different environments over a course of years. We may be in a unique environment where there's lots of money, deal flow, assets that are sitting on the sideline. What surprises have you seen that you have not seen before in your career in this current environment?
Well, the chairman of the investment committee at New York Presbyterian Hospital, where we were the outsourced CIO for 13, 14 years, was George Baker, the Baker family that endowed Harvard Business School. And George was bounced on his grandfather's knee, the same grandfather that helped to incorporate U.S. Steel, and his grandfather would always say to him, Georgie, there'll always be another recession, and it'll always be different. So this is no great surprise that this one is different. They are going to be different. And it's just like what we had on Monday night, not to dig into it too much, but when you have constantly evolving patterns of chaos, you have to stick your knife into the mud and deal with it and have something that can read the tea leaves, visionary tea leaves. And that's why we built what we did off of the fundamentals that originally started with Mike being very fortunate to help build the MIT Fed model. It still guides some Fed monetary policy today. And a lot of the fundamental total shareholder value work I did at McKinsey and BCG and Bain, I just adapted all of those fundamentals. Fundamentals are key. And the three most important things to learn on my first day of training at McKinsey was cash flow, cash flow, cash flow, period. And so that doesn't change. And so you need to see where is that happening? What is the velocity at which it can change, both downside and upside, and what's the elasticity of its range? And to be able to define your risk parameters to narrow them as much as possible. So in a sense, we expected something like this to come along. It won't be the last, but this will be a little bit more long-term, we think, because what we're experiencing here is the same kind of financial repression that we saw from 1967 to 1982. During that period of time, 60-40 lost 22%. So what we're all seeking today is how to replace that 40%. A lot of the things we're talking about that you're interested in, that Kevin has done, et cetera, and by the way, you built it, distress will be back, they will come. And so the key is just to remain as humble as possible, and I think the best definition of hubris I ever heard was from Brit Hume, who said unshakable belief in one's own infallibility. So that's why our fourth component of what we call quatrain, first is risk control. The next one is eliminate as much of this crazy noise and the chaos as possible. Have a strategic vision like the W at the end of the game, but be able to adroitly and very nimbly be able to maneuver within it. And know that you're not going to capture it all, so when you see some sense of intrinsic volatility, you want to be able to impose systematic cash as well, even though you want to avoid that. Ray Dalio said, cash bonds are trash. So understood, you got the message, but let's build opportunities and do it with as little hubris as possible to move forward. So to answer your question, long story short, it's too late. The point is that it is different and it will always be different. Stick your knife in the mud, deal with it.
I like how, did he actually use the term trash?
Yes.
I like that description. You've mentioned, so this is different, but we could be in a similar, recessions and bubbles have happened before. Kevin, you mentioned, talking with people in your network, maybe your son or whatever, that are looking at crypto and day trading and meme stocks, etc. Should any of us have this in our portfolio? Should this be part of any asset allocation for an institutional investor?
I would never do it. I mean, I don't understand it, and I think that if, I've probably asked the question to 100 people around, tell me what you think crypto is, and you'll get 100 different answers. So it might be the greatest momentum, vehicle, who knows, right?
I have an opinion on crypto. So we just did an event in Miami, you were there, and 40% of the people said they own Bitcoin. Who were there, the family offices that were there. So I will give my rundown on crypto, which is that I think everybody agrees there's something called fintech that exists, correct? And that there's a lot of money invested in blockchain right now. And Andreessen Horowitz just raised a $2 billion fund. Sequoia raised a $1.5 billion fund. So I don't think anybody's going to argue there's something called blockchain, right? So the only argument that's left is whether or not these cryptocurrencies like Bitcoin or Ethereum. Now, Ethereum, a lot of DeFi and fintech is based on Ethereum, so that it has value, right? So then you get to Bitcoin, right? So the issue with Bitcoin is that all Bitcoin for the next 5 years is already bought at a strike price, right? So there's futures on it, it's already purchased, right? On all halving, the Bitcoin price goes up by 10x every time. You can just look at a chart, that's the way it works, right? As long as there's somebody who's willing to pay you for your Bitcoin, it's like my old professor at Wharton, Scott Armstrong, said, the worth of a thing is the price it will bring. And as long as there's somebody who will pay for it, that's great. It's worth what it is, right?
And there's the Rick Abelman 1% rule, which is 1%, but 1% into Bitcoin, because the opportunities on the huge swings are so huge, whether you believe it or understand it or not. But 1%, how much can that really hurt your portfolio?
So Dan Moore had said, he was a trader, Tigers, Tigers, and Julian Robinson said, so I'm a trader, it's volatile asset class, I trade it.
Question, how many of the 40% knew what they were doing?
So we had a Bitcoin guy who was giving away Bitcoin in 2015 to people. So he gave away $25 worth of Bitcoin was worth $100. And when Bitcoin took a step up, I was getting so many phone calls like, hey, I lost my password. I mean, they ignored it, they lost it. So my only perspective towards Bitcoin is as long as there's an off-taker, it's worth something.
I think, I don't disagree with anything you're saying. The question to me was, would you do this? And as a value person looking for intrinsic value, I would never do it, right? So we look at what do you really have in crypto? No different than if you look at what I buy Rivian stock right now. I wouldn't do that. So that's just, our personal investing is very conservative, we're very valued. We like to buy a dime for a nickel. That's just what
Absolutely. Yeah. The only analogous point or another point I want to make is that 90% of crypto is owned outside the United States. So what the SEC says doesn't really matter too much,
How much you said, 90?
90% of crypto is owned outside the United
Morning,
States.
Sammy, comment on that?
Yeah.
As a family office, I would prefer to invest that same allocation into precious metals than to do crypto. I am a hard believer and a follower of the value of blockchain as a glorified Excel workbook, protected, but I would rather, if I'm gonna deal with volatility or have a 3 to 5% on the side, not cash, I would go for precious metal.
It's fascinating times.
Gary, did you have something to add to this?
Yeah, I guess one unifying theme that I think I've seen, whether it's Bitcoin or whether it's EV stocks with no actual revenue or a lot of these vehicles, is they're all stories, right? So people are buying stories, and they are buying the hope that the next sucker will buy the story from them for a higher price, with meme stocks, whatever it is, right? And if you study bubbles, that's one of the classic signs of a bubble, is that the focus shifts away from cash flows and assets, which are boring and old fuddy-duddy kind of metrics, right? And we shift to a story. How exciting is the story? who likes it, what's the momentum like, how many other people agree with you, which, by the way, none of that will matter in the end, but it does matter for quite a while in the intermediate kind of point. And if you study, like, so why are we still not buying tulips at crazy prices? No, well, because we're not that stupid as a race. Like, we realized after like the 17th century that, tulips are now worth millions of dollars, but we periodically have the same pattern of behavior assigned to other things. And I don't think there's a difference necessarily between some crazy coin that all of a sudden tanks. By the way, a little story. When Omicron, the COVID variant, got announced, kind of the news came out of South Africa. There was a story on Bloomberg about a crypto token called Omicron the Thing that over the weekend went up 10x. Not because it got more valuable, but because the people were searching for the word Omicron and say, hey, there's this crypto token. It's Omicron the Thing. Let me buy some of that because the other people will be searching for that as well. My point, not to get into crypto because it's not my area of expertise, is that there's a focus on stories and a lack of focus on cash flow and assets. And I have a portfolio of pretty decent businesses that's trading at 6 times what I think is normal free cash flow, mid-cycle, nothing crazy, which means that if these businesses don't grow and just generate that free cash flow stream from now to eternity, you're getting a mid-teens return right there and then. But nobody cares because they're boring, predictable businesses, the kind I like, but the market could care less. And I think that's one of those things that unifies doggy coin, cat coin, monkey coin, and meme stocks and EV vehicle stocks and all of those things, is that stories versus cash flows.
Yeah, I think the issue isn't that. I think the issue is that intangible assets make up about 90% of the value of the stock market right now. And so crypto is intangible. It's an asset, it's computer code. Computer code has value. We all know that. A lot of computer companies blew up in the 90s, but the ones who survived are gargantuan, right? So there's something that has to do with computer code and brand, and it's very real. Maybe it's a network effect. So, but that's a discussion for our afternoon topic. So.
Yeah. Danye, I want to ask Danye just a quick question. Is your investor base, what are they asking about most? What are they curious about most in terms of alternative investments?
If it's a private market, a lot of it is about access. The last point I was making is that historically, a lot of Asian investors come to global markets thinking they have the source of capital, they could probably just access anything they want, but it doesn't work that way. So either you have existing relationships where you back certain funds that have early access to certain deals, and once they go to growth stage, and there's co-investment opportunity, and then you get it. Or there's a strategic alignment. For example, there's one newer family that I recently started working with, has a very strong healthcare background. And they've done a lot of investment. They own healthcare, like basically a large pharmaceutical company, a public company in China. But historically, they've only done investment in Asia. But most of their wealth are US dollar anyway, and they want to do more in US healthcare. But aside from just investing in here through funds and direct deals, there's also strategic alignment, be it about distribution or testing, or other research alignments that they can formulate. But I think if it's private market, access is very, very important. When it comes to public markets, hedge fund, for example, historically, it is also about returns, but I think more going forward is about downside protection and whether or not people can deliver returns on a more consistent basis. And liquidity, I would say, is also very important because Asian investors are not very used to locking up their capital for like 10 years at one time. They're much more familiar with liquidity terms that are like 3 to 5 years or so, which is why a growth equity and private credit type of investment has become pretty attractive. And on crypto, I want to say one note is that I was also in Miami with Marty and the rest of the folks last week. There's actually a lot of Asian investors coming into Miami in Texas or like other parts, Utah, other parts of the US and Canada, specifically seeking mining facilities. So you guys might be aware the Chinese government have banned all the mining, crypto mining in China. So a lot of these families are in the process of moving the miners out to Canada, the US, or even like Russia, Kazakhstan of the world. Some of the families want to do it themselves. Some of the families want to find partners over here to do it. But for those people because a lot of the Asian investors, as I said, real estate is a big sector. So they kind of treat mining as coming into crypto sector from an infrastructure play. It's more tangible. So it's easier for them to understand and easier to get in.
And NFT space is also massive with the Asian community, right? And it might be kind of locked in with the gaming.
Yeah,
A lot of NFT around
DeFi, the challenge here, which gets a little bit tricky, is that NFT also kind of become an instrument for people to move their capital out, because you can get in with whatever currency, but yeah.
That's
So
always been
that's another element, like
Yep.
it's hard in NFT.
I know that, wow, this has gone fast. Let's address a few questions before the next speaker, and who knows, maybe we can get into one more topic. But there's a question that came out from Rob on panelist preference of US versus overseas investing. Brian, you got something to say on that? Kevin?
We've looked historically at a lot of things overseas and never did. So when Bank of Ireland or NAMA or the Spanish Fed banks, and we get calls to look at certain asset classes. And invariably, you know, the head scratcher, or the reason why we did not do it is that there's got to be someone, especially for real estate, that's local, that knows more about this asset class than us, to take our capital over to Spain or Ireland or the UK. So unless it's a really, really cheap asset at a huge discount, we really never compensated for that risk. So whether it's jurisdictional law or just local, players, we've always felt like we are at an information disadvantage. And that's why I struggle with kind of global real estate investing. It means you have too much money. You can't really diligence everything the right way from our perspective.
And for us, big data is our rocket fuel. And in the OCIO world, we have a lot of investments internationally. And we're always careful to address three key questions. When investing in an overseas country, especially emerging markets, is there the infrastructure to pay? Is there the ability to pay? And finally, is there the willingness to pay? Really frightens people to talk about question. So and liquidity is what matters. For our particular strategy, liquidity is central. And having transparency and control for the investor. So even though we call it Quatrain Global Solution, Quatrain, no prophecy, just vision, the reason that we chose US-based ETFs is that they were the most structurally stable components that we could find, and were daily liquid. And intraday liquid, especially when we have to stick that knife in the mud and you have perpetual chaos. You need that liquidity, you want to be able to have it. So we have ignored securities for the time being that are international. We have focused on the US-based ETFs for our strategy.
I was the one who submitted that. I'm the Rob here. Just on the corollary that of the Irish deal and your comfort of the US, were you able to convince some of them from overseas to co-invest with you here domestically? You might have to repeat it for Ben.
Sorry, we have only one family that's outside the United States that we invest for. So we're not really looking for a lot of new families. We have a stable of 25 families that I speak to. And the reason why we set it up that way is I realized early on that they collectively had more money than I could raise in my lifetime. So we just try to find good, solid investments. We capitalize it, and we socialize it to our group, and we don't know who's going to be in it. And that's what we're doing right now as we speak. And it's different than raising a fund and trying to find an investment. So I struggle with that around, like, you have all this money and then you're forced to go make an investment versus I found an investment, I like it, I like the risk, it's current, it's relative to what's going on in the world today, and then you capitalize it. And that's kind of how we do it.
Got it. Gary, did you have anything to add on this?
Yeah, from a kind of public markets perspective, I would say the US market is one of the more unattractive markets right now. I think one of the differences between the last bubble and the current bubble is when you have the tiering effect, where you have kind of the overly expensive tier and the cheap tier. Like in the late 90s, 2000, you had a very broad cheap tier of high quality assets, like industrial companies that were trading at 8 to 10 times free cash flow. They were growing, they were just not in the TMT bubble. And right now, the tier of really cheap stocks in the US is very, very narrow, and a lot of them are cheap for a reason. And it's a dangerous place to be. You have to really know what you're doing. So I'm finding a little bit more of opportunities outside the US than in the US in the public market.
Yeah, aside from with Asian families, I also advise a few venture and growth equity fund, especially from China, the US dollar. The point I wanted to make is that a lot of US investors are probably, because we all know we don't invest in things we don't understand, so people might be scared of China, or don't have the capacity to understand it, or don't have local relationship to access it, which makes, I perfectly get it. So a lot of people have shied away from allocating into Asia or China, but I do think just like crypto in certain ways, as an asset class, we probably deserve a portion of the allocation longer term because of two things. One, it is still one of the fastest growing region in the world, and the fundamentals are strong, I guess, depending on the specific sectors we're looking at. If we're talking about consumer or even healthcare, frontier technology, enterprise software, those are all growing sectors with dedicated players in all those industries. And the second is that because of the maturity of the US market and the immaturity of Asian market, there's still a lot of opportunities to extract value if you come in as a sophisticated institutional player. Because of the Asian market, they're still largely speaking retail oriented. So if you actually do come in with a long-term view and the skill set of a mature marketplace, you actually have an advantage against some of the local investors. So align with people who are on the ground and understand what they're doing and have the sector expertise, but at the same time really have a long-term view and more, I guess, long-term capital source. And that is how you can actually win in the Asian market. So I do encourage people to look at it, but obviously take your time to build that trust and understand the local dynamics.
Marty, do we have time for one more question, or are we gearing up for the next panel?
Yeah, we have time. Yes, yes.
All right, one last question.
Marty, there's
Everybody has less than a minute. Oh, is there another question in the audience?
Good morning.
Yeah. Oh, sorry. All right. This question for Kevin. Kevin, I'm also an ex-Sigma, by the way. You said you don't allocate capital to crypto, which, by the way, we have the same issue. We run a long-short value fund. We went to our LP. They told us you're crazy, so we split up the family office only for the GP to invest in. But we took the time to understand the asset class, right? And then we think that they're not all the same, right? I mean, there's some garbage out there that's going to go to zero. We've gone for the .com. There's some use cases, Bitcoin, perhaps Ethereum, maybe other protocol. Is that because you didn't have the time to dedicate to understand the asset class? Or do you think that will perhaps be a style drift and that perhaps jeopardize the relationship that you have built with these family offices?
Well, the short answer is, if you don't know anything about it and someone's smarter than you, then I'll defer to them. We don't know enough about it to feel confident. When we make a real estate investment or we come in through the structure, and we think we're the best in the world at that. And so when you have that intellectual skill set and you combine that with world-class capital and you're in a unique spot, you're gonna win. If we start to venture into crypto, there's 1,000 people out there, maybe 100,000 people that know more about crypto than I do. So I would never put myself and my reputation at risk to do that. I'm not saying it's not worthy. It's just not for us. That's just simple. We don't drift. We find things that we can underwrite, that we can understand, and then we feel good about the risk reward payoff for it. But thanks for the question.
He had a question.
No, I thought it goes back to you. You want me to ask the question?
Yeah, one last question, yes.
Okay, great. Asia, I think, is one that we actually have been looking at in the fintech space. There are a lot of players in the B2C, but we don't see a whole lot in the B2B2C. Is there a reason for it, or is it just the way the market is set up.
Yes, so a lot of the B2B service or like enterprise SaaS companies in the US that has tremendously grown in the past decade or so is because part of it is because efficiency, corporate efficiency is valued at a different level in Western society than places like China, rest of Asia, because labor cost is much cheaper in China. So for a while, it's actually easier maybe just to employ more people to solve whatever problem they have instead of creating a software or a more efficient way of doing things. And enterprises in China historically did not have an incentive to pay software. And also confidentiality and data security were also viewed in a very different way in Asia. But in the past 5 years or so, that is changing. So enterprise software is one of the biggest and fastest growing venture industry in China. There are a lot of vertical specific funds coming out, and those were ex-partners from Hill House and Sequoia, Matrix, some of the probably the most prominent venture or PE platforms in China. So I do think that trend is coming, but it's still at the early stage. And one caveat here is that China has central government, but also like state and local government. So historically, if you are an enterprise software company or 2B2C and you serve the government always unfortunately delay on the payment, and sometimes it's I guess how people treat contract is kind of also a different dynamic than Western society. But nowadays, in most recent years, labor cost has also increased in places like China, and how people compete in a more sophisticated society, efficiency become more and more important, which is why we see a tremendous pickup in enterprise industry. And also there's a lot of overseas returnees who have worked at SAP, Oracle, Salesforce, for example, from Silicon Valley, going back to Asia. And they are in a very good position to build enterprise software and like to be 2C business. So personally, I'm very positive on this vertical.
Fantastic. Ben, great job.
This could have gone on for another hour because I have like 5 other questions, but we'll save that for the next session. So thank you all.